RateScope here. Major policy development. U.S. Vice President J.D. Vance told a meeting of more than 50 countries on Wednesday, aimed at boosting access to critical minerals, that the U.S. will establish a system creating price floors for these commodities. Reuters confirms. The United States will establish a price floor system for critical minerals. Big news. The global scramble for critical minerals continues, and silver is included in this system as a classified critical mineral. But before we get into what that means, let me show you the pattern that's developing today. Again, we got rejected from the $90 zone and came back to $83. That's about 8 to 9% down from 90. And this event happened during the New York session, same as yesterday. Silver prices posted a massive reversal, falling nearly $9 per ounce in under 3 hours. Gold prices also fell about $220 per ounce in under 3 hours. What pattern do you see in this scenario? So far, we have not found a daily close above $90. Looking at the numbers, about 75% of you watching aren't subscribed. If this unfiltered, real-time analysis is cutting through the noise, giving you the whole story from both sides, backed by verified data, and helping you make clearer decisions, then hit subscribe. This channel isn't about telling you it's going to the moon or going to zero. It's about raw, unbiased perspective with verified data. That's how we grow a community anchored in reality, not hype. If this adds value, drop RateScope in the comments. It helps me see what matters to you and keeps the analysis grounded in what's real. In my previous video, I discussed that around 96-97, we have resistance at the 150 EMA on the hourly chart. We're currently at 86. That's $10–11 below that resistance. The pattern is clear. During Asian and European hours, silver rallies. During the New York session, massive selling hits and we reverse. Yesterday, up to 90, then back down. Today, up to 90, then back to 83. The $90 zone is acting as strong resistance, and the New York session is where the selling pressure consistently appears. Based on all this, what pattern do you see? Up all night on global physical demand, down all day via derivative selling in New York. That's the pattern. Physical buyers accumulating overnight, paper sellers dumping during U.S. trading hours. It's happened 2 days in a row. Now the question is whether this pattern continues, or if we finally break through 90 and hold. Current prices as I'm recording. Silver Western Spot, $86. Western Futures, $86. Shanghai Spot, $102. Shanghai Futures, $101. Shanghai Premium, $16. 19% premium. After getting rejected at 90 and dropping to 83, we've recovered slightly to 86. But the pattern of New York session selling is undeniable. Now let's connect this to the massive policy announcement. The U.S. establishing a price floor system for critical minerals fundamentally changes the game. Price floors aren't about paper markets. They're about keeping production alive. If paper prices don't cover real costs, the floor won't follow paper. Paper will be forced to adjust to the floor. That wouldn't be a rally, it would be a repricing event. Know the difference. And here's the critical question nobody is asking. What if the silver price floor is set above the current paper price? Price floors are designed to ensure domestic production remains viable. If the floor is set at, say, $90 or $100, and paper is currently at 86, what happens? Paper would be forced to adjust upward to meet the floor. This isn't speculation. This is how price floor mechanisms work. The government sets a minimum price to protect strategic industries. If the market price falls below that, the government becomes the buyer of last resort at the floor price. America is going to have a floor price for silver, meaning you won't be able to sell or buy silver below a certain level. This is unprecedented in modern precious metals markets. The Strategic Petroleum Reserve has a similar mechanism for oil. Now critical minerals, including silver, get the same treatment. The implications are enormous. Now let's talk about what's happening on the physical delivery side. 14.8 million ounces of silver delivery notices hit COMEX vaults in the first 4 days of February. Another 190 February silver delivery notices were issued Tuesday. Total February silver deliveries have spiked to 2,955 contracts, 14,775,000 ounces. At the close on January 30th, open interest in the February silver contract was just 1,231 contracts. Yet by Tuesday, only 2 days later, 2,955 delivery notices had been issued for that contract. Nearly 3 times the entire open interest at month end has already issued delivery notices in the first 2 trading days of February. Yet February open interest still sits around 1,051 contracts. This means new longs are entering and standing for immediate delivery of physical silver. For the second month in a row, a non-primary delivery month has seen historically massive silver delivery notices. And it's only the 4th day of the month. Let that sink in. Open interest, 1,231 contracts. Deliveries issued, 2,955 contracts. That's 2.4 times the open interest demanding physical delivery. New buyers are entering, demanding immediate metal, and open interest stays low because they're taking silver out and leaving. This is not normal. Primary delivery months, March, May, July, etc., typically see high delivery activity. Non-primary months like February usually see minimal deliveries. But February just posted 14.8 million ounces in 4 days. This confirms physical demand is relentless despite paper price volatility. Here's the part nobody's talking about, and it explains everything. The 1-year silver swap minus U.S. interest rates shows silver market imbalances larger than during the 2008 financial crisis and the 2011 silver mania. New highs may come sooner than expected. A sell-off driven by over-leveraged paper positions is not the same as a true oversupply. The structural imbalance in the silver market is at historic extremes, larger than 2008, larger than 2011, and now the U.S. government is stepping in with a price floor system. Central banks are the quiet, underappreciated, unseen whales in this market. For several years, central banks led by China, Russia, India, and Turkey have been buying gold at a historic pace and have just topped 5,000 tons for the first time in history. This relentless central bank buying acts as a massive, price-insensitive bid. They're not scalping a few dollars. They're accumulating strategic reserves for the long term in ever larger amounts. Americans mostly seem totally unaware of the intense gold and silver buying happening across the rest of the world. They think because Americans aren't buying, nobody else is. They will pay dearly for that ignorance. China gold and silver demand remains stable. Global physical demand is not collapsing despite paper price swings. Today hurt a lot, so let's get real about the risks right now. U.S. stocks are dumping. S&P 500 down 0.95%, erasing about $580 billion in market value today. NASDAQ down 2.4%, wiping out roughly $1 trillion today. Russell 2000 down 2%, losing around $64 billion today. Risk is being sold across the entire U.S. market at the same time. Nuclear talks between the U.S. and Iran scheduled for Friday have reportedly been canceled. Oil prices are surging towards $65 per barrel on the news. Geopolitical tensions are escalating. China's 4 largest gold-backed ETFs posted a combined $980 million in outflows on Tuesday, the biggest daily withdrawal on record, 2.5 times the previous record from May 2025. This follows $317 million in outflows Monday, bringing the 2-day total to a record $1.3 billion. Sentiment in Chinese gold markets is seeing massive swings. MicroStrategy's Bitcoin position is now down over $2 billion as Bitcoin drops below 73,000. Ethereum falls below 2,100 for the first time since May 2025. The pattern is clear. Rejected at $90 during the New York session 2 days in a row. No daily close above 90, yet 150-hour EMA resistance at 96.97. Price now around 86. Risk-off sentiment spreading across equities and crypto. Iran nuclear talks canceled. If this pattern continues, we could test lower levels again before finally breaking through. But here's why the bearish case is overwhelmed by structural developments. The U.S. is establishing a price floor system for critical minerals, including silver. 14.8 million ounces delivered in the first 4 days of February, 3 times the end-of-month open interest. Silver market imbalances larger than 2008 and 2011. Central banks accumulating at record pace. Global physical demand stable. The $90 rejection pattern during New York sessions is a paper phenomenon. The price floor announcement is government policy responding to strategic necessity. Ray Dalio is openly calling for gold to be the world's new currency to replace the fiat system. It's the beginning of the end of the monetary regime as we know it, which is why central banks are choosing gold, and by extension silver, as reserves. For this to happen, gold and silver must trade significantly higher than current levels. The entire system is being repriced. Nothing looks organic. Every asset class shows signs of manipulation. The goal isn't to fix the system anymore. It's to extract value before restructuring. Bitcoin advocates wanted a strategic Bitcoin reserve. Instead, the government created a critical mineral reserve that includes silver. They prioritized strategic minerals over speculative digital assets. That tells you what is actually considered critical. Let's cut to the chase. 3 must-know takeaways before we close. Number 1. U.S. Vice President Vance announces a price floor system for critical minerals, including silver. This fundamentally changes market structure. Price floors are designed to keep domestic production viable. If the floor is set at or above current paper prices, paper must adjust upward. This is government policy, not market rumor. It's the Strategic Petroleum Reserve model applied to metals. The implications for silver as a classified critical mineral are enormous. Number 2. 14.8 million ounces of silver delivery notices in the first 4 days of February. 2,955 delivery contracts versus 1,231 open interest at month end. 3 times open interest demanding immediate physical delivery in a non-primary month. New longs entering and taking metal out immediately. This is the second consecutive month of historically massive deliveries in non-primary months. Physical demand is relentless despite paper volatility. Number 3. Pattern established. Rejected at $90 during New York session 2 days in a row. 8 to 9% intraday reversals both times. No daily close above 90, yet 150 EMA, hourly, resistance at 96.97. Up all night on global physical demand, down all day via derivatives in New York. Risk-off sentiment spreading, Iran talks canceled, China ETF outflows at record levels. But silver market imbalances are larger than 2008 and 2011. Structural tension is building. The unresolved tension is this: a price floor system for critical minerals being established by the U.S. government. 14.8 million ounces of physical delivery in 4 days. Silver market imbalances at historic extremes. Yet we can't break through $90 resistance, and New York session selling keeps knocking the price back. Does the $90 rejection pattern continue until the price floor mechanism is implemented, or do we break through based on physical demand overwhelming paper supply? The government is responding to strategic reality. The paper market is responding to leverage and positioning. Which force wins in the short term will determine whether we test lower or finally break 90 and move toward that 96-97 EMA resistance on the hourly chart. Do your own due diligence. Understand the risks. The $90 rejection pattern is real. 2 days, 8-9% reversals during New York hours. Risk-off sentiment is spreading. Iran tensions are escalating. But the U.S. government is building a price floor system for critical minerals, including silver. 14.8 million ounces of physical delivery in 4 days. Silver market imbalances at record extremes. The paper pattern and the structural policy developments are moving in opposite directions. Know which time frame you're trading. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. RateScope out.